Most people think today's real estate market is confusing. It's not confusing, it's misunderstood. Hello, I'm Neena Jindal of the Suburban Home Specialist of Keller Williams here in New Jersey, and our results will move you. And if you follow my weekly Markets of the Moment updates, you know my role is not just to tell you what happened, but to help you understand why it's happening and what actually it means for you here in Millburn, Short Hills, and our surrounding Midtown Direct train line towns in New Jersey. Every month, I go straight to the source. I read what the National Association of REALTORS came up with its annual 2025 report, and it's actually publishing. Not headlines, not sound bites, but the real research. And what it stands out is this: housing today is not being driven by panic or hype. It's being shaped by long-term economic forces that most people aren't talking about clearly enough. If you already own a home, this is the most important thing to understand. Real estate remains the primary way households in this country build long-term generational wealth. Not stocks, not short-term investments, but housing. Over the last decade alone, the typical homeowner nationally gained close to $250,000 in equity. That didn't come from timing the market, it came from time in the market. Another big misconception I want to clear up is inventory. People keep waiting for more homes to come on the market. But what the data shows is that low inventory today isn't just cyclical, it's structural. Millions of homeowners are sitting onto 3 to 4% mortgage rates. They don't need to move. Add to that fact that people are staying in their homes longer than ever, and supply doesn't replenish itself the way it used to. That matters here. In towns like Millburn, Short Hills, demand hasn't disappeared. It's become more selective. Homes that are priced correctly and prepared properly still move. Homes that aren't, don't. The gap between these two outcomes is widening, and that's no emotional, that's mathematical. There's also a policy layer that most homeowners didn't think about. Capital gains thresholds on home sales haven't kept up with inflation. That alone keeps many long-time owners from selling, which further tightens supply. When you put all of this together, it explains why well-located homes in strong school districts continue to show resilience even when national headlines sound uncertain. Now, if you're a buyer, that's what the data is really saying. Affordability challenges have not removed buyers from the market. They have changed buyer behavior. Nationally, the average first-time buyer is now around 40 years old. That tells us people aren't giving up. They are waiting longer, planning more carefully, leaning on family support, or expanding their search intelligently. One of the most overlooked points from NAR research is this: a fixed-rate mortgage remains one of the strongest inflation hedges available to households. Rent resets every year, a mortgage doesn't. Over time, that stability becomes an advantage, especially as income rises. That's not a sales pitch, that's simply economics. We are also seeing what economists call dispersion. Buyers are active across price points and towns, but with more thought, more questions, and more focus on long-term livability instead of short-term excitement. And despite all the technology and data available today, people aren't less reliant on guidance. They are more reliant on interpretation. More information simply doesn't simplify decisions. It makes trusted context more valuable. And for investors or long-term thinkers, this is where housing really shows its weight. Real estate still represents close to 20% of the US GDP. When housing moves, employment, spending, and local taxes move with it. This isn't just an asset class, it's an economic engine. NAR also highlights that every single home sale supports roughly 2 additional local jobs. In town like ours, that ripple effect supports contractors, small businesses, schools, and municipal services. Housing isn't isolated, it's deeply connected to the community health. Another long-range insight worth paying attention to is this: the wealth gap in this country increasingly tracks homeownership, not income. Homeowners tend to experience greater financial stability, stronger community ties, and better long-term outcomes. That's why ownership demand, rental demand, and neighborhood quality are always linked. So when I step back and look at what this data is actually telling us, the takeaway is not urgency, it's not fear, it's clarity. Housing remains foundational to financial stability, community strength, and generational wealth, especially in high-quality towns like Millburn, Short Hills in New Jersey, and all the other Midtown Direct train line towns. My job is to help you understand how these national trends intersect with your local reality and your personal plans. Whether you're staying put, thinking about a move, or planning long-term, you deserve insight, not noise. And if you want to stay informed, make sure you're watching my weekly Markets of the Moment updates. As always, I'm Neena Jindal with Keller Williams. Our results will move you into Jersey. Have a terrific day.